What if you could use your Bitcoin without ever selling it? And now, that exact same strategy is available to Bitcoin holders. But there's a catch, and if you don't understand it, you could lose everything.
So, you're a long-term Bitcoin holder. You've got this incredible asset, right? But most of the time, it's just sitting there. What if you can tap into its value? You know, get cash for a down payment, a business idea, whatever, without ever having to sell a single Satoshi. Well, today we're going to break down exactly how to do that.
All right, here's our game plan. First, we're going to look at the real problem with just hodling and why selling is often a trap. Then, we'll get into the strategy that wealthy investors have been using for ages, borrowing. Now, the next part is absolutely crucial. We're going to stare the two biggest risks right in the face and then build a step-by-step playbook so you can navigate them safely. By the end, you'll have a crystal clear framework.
Okay, let's kick things off with the problem that's kind of hiding in plain sight with the whole HODL strategy. I mean, your conviction in Bitcoin is why you're holding it, and that's great. But while it's sitting there, is that asset really working for you? Or is it just collecting, well, digital dust?
Think about it for a second. If you're doing things the right way, holding your Bitcoin in self-custody with your own private keys, the yield it's generating is a big fat zero. It's not like stocks paying dividends or a rental property bringing in cash. Bitcoin, as a bearer asset, is designed for one thing above all else: secure holding.
And this chart, wow, it really puts that opportunity cost in perspective, doesn't it? Even something as basic as cash, sitting in a high-yield savings account, is putting in some work, earning a return. That Bitcoin you're holding that's earning zero, well, that represents thousands of dollars in potential income you're just leaving on the table every single year. That's the real hidden cost of hodling.
So, if just holding isn't ideal, what do you do when you actually need cash? Well, the knee-jerk reaction for almost everyone is to sell. But as we're about to see, that obvious move, it comes with some seriously high and often overlooked costs.
See, selling isn't just a single action. It's like tipping over the first domino in a long line. The moment you sell, you get your cash, but you also instantly trigger a tax bill. And maybe the biggest hit of all, you completely give up any and all future gains on the Bitcoin you just sold. It's gone from your portfolio forever.
And this is where it really starts to sting. Let's make it real with this example. You sell your Bitcoin at $30,000. Later, the price runs up to $60,000. You're stuck on the sidelines, having missed out on a $30,000 gain. And to add insult to injury, you still owe the taxman capital gains on that original sale. It's a double whammy.
So, what's the smarter play here? Well, we can actually take a page directly from the playbook of the super wealthy. When they need cash from, say, their real estate portfolio, they don't sell the building. No way. They borrow against its value. And guess what? That same powerful financial tool is now available for your Bitcoin.
Just look at the difference between these two strategies. It could not be more night and day. On the left, selling is a permanent, dead-end decision for that asset. You lose it, you pay taxes, and you forfeit all future growth. But on the right, borrowing, it keeps the asset alive. You keep your position, you don't trigger a taxable event, and you keep all the potential upside.
And the process itself is surprisingly simple. You just deposit your Bitcoin, which acts as collateral. In exchange, you get a line of credit. You can draw cash from it instantly, all while you maintain full ownership and exposure to your original Bitcoin position. Simple as that.
Okay, everybody, let's hit pause right here. This next section is, without a doubt, the most important part of this entire explainer. Borrowing is an incredibly powerful tool, but it is not a free lunch. There are two major risks, two critical trade-offs you are making, and you have to understand them completely before you even think about doing this.
You've heard this a million times, I know, and for a very good reason. Not your keys, not your coins, is the absolute bedrock of security in crypto. When you decide to borrow, you are knowingly stepping away from this principle. This is the first and honestly the biggest risk you take on.
We call this counterparty risk. The easiest way to think about it is this. It's like taking your gold bars out of your safe at home and putting them in a bank's vault. You are trusting that bank, your counterparty, to keep it safe. You're giving up direct control, and you're trusting that platform won't get hacked or go bankrupt. We all saw the collapses in 2022. That was a brutal, real-world lesson in what happens when this trust gets broken.
All right, so that's risk number one. The second major risk has nothing to do with trusting another company. It is pure, cold, hard mathematics. It's all about how Bitcoin's infamous price volatility plays against the structure of your loan.
Let's run some numbers so this makes sense. Let's say you post $50,000 worth of Bitcoin as collateral and take out a $10,000 loan. Your loan-to-value, or LTV, is just the loan divided by the collateral.
In this case, that's 20%. At this level, everything is great. Your loan is in a very healthy, very safe position.
But, and this is the big but, we are talking about Bitcoin. And we all know what happens when the market does what the market does, a sudden, gut-wrenching price drop.
Now look at the numbers. The value of your collateral just fell to $33,000. Your $10,000 loan is still there, but your LTV suddenly shot up to 30%. Now your loan's health is in the warning zone. If the price keeps dropping and your LTV hits a critical point, let's say 80%, the platform will be forced to sell your Bitcoin to pay back the loan. That's called a liquidation, and that's the nightmare scenario we have to avoid.
Okay, so we've clearly identified the two enemies here, counterparty risk and liquidation risk. So now, let's build the playbook. Let's figure out how to manage them so you can use this strategy with confidence.
Here's the #1 mistake people make. They get greedy. They borrow the absolute maximum amount the platform will let them. The secret to doing this safely is to be conservative. First, start with a very low LTV. 20% is a fantastic starting point. It gives you this huge cushion against volatility. Second, you need a fire drill plan. Know exactly where you're going to get extra cash to either add more collateral or pay down the loan if the market really turns south. You have to be ready to act fast.
So let's boil this all down to a few hard and fast rules. Think of borrowing as a surgical tool, not your new bank account. Your defaults always should be self-custody. Only deposit what you absolutely need to borrow against, never your whole stack. And borrow only what you need, not the maximum they'll give you. And finally, only pull the trigger if the math is clear. The cost of borrowing has to be way less than the combined cost of selling and paying taxes.
So, there you have it. We've unlocked a totally new way to think about your Bitcoin, not just as this passive store of value, but as a productive, working asset. It's a powerful tool for getting cash when you need it. But like any powerful tool, it demands respect, it demands a plan, and it demands a clear-eyed view of the risks. So the question I'll leave you with is this. Now that you have this tool in your toolkit, how are you going to put your assets to work?
If you want to use strategies like this safely and intelligently, subscribe, because this is where we break it down.